Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 10th of June 2020. And yesterday we produced a video entitled Government Stimulus and Stock Market Tops. And on Monday, World Bank paints gloomy picture for 2020, particularly for the emerging markets. And on Sunday, is China still the future? Where we highlighted that China's economy seems to be improving at a much faster rate than elsewhere. Now, in yesterday's video, we showed a Bloomberg article which suggested that equity markets may now be reaching their medium-term zenith, despite the vast amounts of government and central bank stimulus and liquidity being pumped into the US and, in fact, the world economies. Now, the time of producing this podcast is again quite late in UK time, as it's 21:44 GMT plus 1. And a few hours ago, Bloomberg published two articles. The first on the important news of the day, the FOMC announcement with regards to its treasury and bond buying program, and the second on market reactions to the Fed's announcement. So let's take a brief look at both these articles consecutively. Bloomberg article dated June 10th, 2020. Updated 7:30 p.m. GMT plus 1. Headline: Fed puts floor under bond buying, sees zero rates through 2022. The Federal Reserve pledged to maintain asset purchases at least the present pace, and projected interest rates will remain near zero through 2022 as policymakers attempt to support the economy's recovery from the coronavirus recession. To support the flow of credit to households and businesses over coming months, the Federal Reserve will increase its holdings of treasury securities and agency residential and commercial mortgage-backed securities at least at the current pace to sustain smooth market functioning, the Federal Open Market Committee said in a statement Wednesday following two-day policy meeting. A related statement from the New York Fed specified that the pace of the increase would be about $80 billion a month for purchases of treasuries and about $40 billion of mortgage-backed securities. The dollar remained lower on the day while US stocks jumped after the news of the Fed's decision. Acting on mortgage-backed securities and treasuries underscores their belief that more support is needed, said Diane Swank, chief economist with Grant Thornton in Chicago. The Fed does not see a victory in the employment bounce back. The risk of deflation is still high, and the economy needs more support to heal more fully. The vote to keep the federal funds rate in a range, or I should say target rate, in a range of 0% to 0.25% was unanimous. Chairman Jerome Powell will hold a press conference at 2:30 p.m. Washington time. The Fed's quarterly projections updated for the first time since December after officials skipped their March release amid the burgeoning pandemic showed all policymakers expect the funds rate to remain near zero through the end of 2021. All but two officials saw rates staying there through 2022. The economy faces considerable risks over the medium term, the Fed said in its statement, reiterating language from the last FOMC meeting in late April. Officials forecast the US unemployment rate would fall to 9.3% in the final 3 months of the year from 13.3% in May, according to median estimates, and to decline to 6.5% in 2021. US GDP was projected to contract by 6.5% this year before rebounding 5% next year. End of article. Article headline: Stocks drop with dollar treasuries jump after Fed markets wrap. Now this was updated today, June the 10th, at 8:11 p.m. GMT plus 1. US stocks turned lower and the dollar slumped as investors assessed the Federal Reserve's views on the economy. Treasuries rallied. The S&P 500 retreated after Chairman Jerome Powell suggested the pandemic could inflict permanent damage on the American economy, even as the Fed signaled it would keep rates near zero possibly for years to come. The Treasury curve steepened sharply after the central bank said it will at least maintain the current rate of bond purchases. US equities have rallied more than 40% from their March lows as central bank asset purchases and unprecedented stimulus sparked demand for risk assets. Earlier Wednesday, Treasury Secretary Steve Mnuchin said that the US definitely needs additional fiscal stimulus. Stocks may be the ultimate beneficiary of trillions of dollars in economic stimulus from the Fed, according to Savita Subramanian, Bank of America Corp's chief US equity strategist. Liquidity looking for a home is bolstering the FANG stocks, Facebook, Amazon, Netflix and Google, and Alphabet, its owner, along with their technology-driven peers, she wrote in a report this week. The danger, though, is that any complication in the economic recovery could see market gains swiftly reverse at a time when there's less room for additional support. The pandemic is splintering the world economy, and policymakers can't risk a premature withdrawal of lifelines to businesses and the most vulnerable people, the Organization for Economic Cooperation and Development warned. The top US infectious disease specialist, Anthony Fauci, called the outbreak his worst nightmare and warned that the deadly outbreak is far from over. End of article. Well, clearly equity markets, which liked the announcement initially, changed its mind shortly afterwards. Now currently the Dow Jones Industrial Average has slipped just below the 27,000 mark and is standing at 26,989. And the S&P 500 is also in negative territory, down 17 points at 3,190. Not earth-shattering moves, but a change of trend. Now, before they closed, most European markets were down, albeit less than 1%. Now, although the Fed did not change rates, it did project slow economic growth for a number of years. And this caused the dollar to fall, and the dollar index is down 0.21 at 96.10. Gold and silver, however, have been the beneficiaries today, with gold up on a 24-hour basis, $21 at $1,736, and silver is up 57 cents at $18.13. Still now within our 1750 to 1850 range, but having surpassed $18 again may now be viewed as quite bullish. Now we are, of course, going to be interested in the equity markets follow through tonight in Asia and then tomorrow in Europe. But the market is aware that currently facing the US and really global economies at present is the potential for deflation and not inflation. And so more stimulus is clearly on the cards in the weeks ahead, which, as we all know, in the main proves beneficial for gold in particular and silver secondarily. Now tomorrow we have the weekly jobless figures, which will be interesting, together with the producer price index for May. But it's the after effects of the FOMC meeting and Fed Chair Powell's comments this afternoon which are setting the scene for the week ahead, if not weeks ahead, much of which we will comment on in greater depth tomorrow. So meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we update our Richard and Greg channel every few days, and there will be a new submission to that channel tomorrow. And also, by all means, please comment and remark on your views of where you see these markets heading. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.